Welcome to the Ultimate Beginner's Guide to Day Trading. In this free video course, you learn the basic concepts and strategies used in day trading. Beyond that, you will learn the main advantages and disadvantages of this mode of trading, which is an extremely important thing to do if you are a beginner. I will also point you to different resources if you want to go deeper into the study of day trading. If you're new to the channel, please consider clicking the like button and subscribing to the channel, as this helps support the ongoing creation of free videos like this one. Without further ado, let's begin the course. Day trading is the mode of trading where traders will enter and exit a position in the same trading day. If a trade is carried to the next day, it's no longer a day trade. Day trading gained a lot of popularity after the 2008 financial crisis. There are many reasons for this, but the main ones are that brokers began to offer extremely attractive conditions for day trading, like low spreads, low commissions, high leverage, and the possibility to open a trading account with a small amount of capital. There are a few details you should be aware of regarding the difference between day trading and other modes of trading like swing and position trading. The first thing is that intraday prices react more to noise rather than fundamental and macroeconomic factors. For example, if a day trader chooses a stock to trade, it's counterproductive to look at the fundamentals of that stock because the fundamentals work in a time horizon that is much larger than one day. Fundamentals consolidate in the mid and long terms, while day trading is about what happens with intraday prices. The consequence of this is that intraday prices tend to react more to noise, volatility, volume, certain price patterns, and certain key levels, and less to fundamental and macroeconomic factors. The second thing is that news events and major economic releases can cause unpredictable reactions in intraday prices. It's nearly impossible to anticipate how the market is going to react to economic releases, and it's certainly impossible to predict news events. There's not much traders can do about news events. By the time you hear about them, it's already too late. As far as economic releases go, it's better to avoid trading around high-impact ones due to this uncertainty that surrounds them in intraday prices. The third thing is that volatility and volume can be unpredictable sometimes in intraday prices, because large players like funds and banks can enter large positions at any time and distort whatever intraday pattern retail traders were looking at. Another thing that is noteworthy is the impact that transaction costs and slippage can have on day trading. It's not uncommon to find day traders who overtrade due to a scalping strategy, for example. Traders must pay attention to the impact that transaction costs and slippage cause in their accounts. If these two variables start to represent a large portion of your trades, it's time to change your strategy. Transaction costs and slippage should not be limiting factors to anyone, especially in today's market where brokers offer good conditions for the retail trader. Overtrading in markets that don't have too much liquidity will create problems in terms of transaction costs and slippage. In summary, try to avoid overtrading as much as possible and choose markets with good liquidity. Before we begin talking about more specific aspects of day trading strategies, we can establish two overall guidelines that usually help day traders in the broad sense. The first guideline is that for directional trading, waiting for a pullback will usually improve entries. And the second guideline is that, for day trading, mean reverting strategies tend to work better than trend following because trends are rarely sustained during the day. Intraday prices are more about noise rather than trends. We can also establish a basic guideline about timeframes. Most day traders use timeframes that can be summed up to 1 hour, like the 1 minute, 5 minute, 15 minute, and 30 minute timeframes. For example, 5 minutes times 12 equals 60 minutes. Unusual timeframes like 7 minutes or 45 minutes cannot be summed up exactly to 1 hour, so they are not used as much. Most day traders will be between the 1 minute and 30 minute timeframes depending on how their trading sessions are arranged and how much time they have at their disposal to look at the charts. Now it's time to begin talking about the peculiarities of day trading when it comes to price patterns that appear in certain times of the day. As a consequence, we'll discuss the famous day trading systems that emerge from these notions. We begin the study by looking at how day traders project the highs and lows of the trading sessions. In standard finance, there's something called Markov assumption, which states that the best prediction for tomorrow's price is today's price, and everything else that comes before that is irrelevant. Out of this notion emerges a few different methods for calculating the projection of tomorrow's key levels based on today's prices. The simplest of these methods is the calculation of pivot points and the resulting support and resistance levels related to that pivot point. In this slide, you can see the formulas for calculating the pivot point, 2 support levels, and 2 resistance levels for today's trading session based on the prices of the previous trading session. Pivot points have been used by many traders for decades, so there are still a lot of people who pay attention to these implicit levels. There are many ways of calculating pivot points. An alternative method to the one we just saw is calculating pivot points based on the average range of the previous days. The range of a trading day is the distance between the high and the low. To calculate the average range, we simply sum the range of X number days and divide that number by X. The standard for this technique is 14 days. To calculate tomorrow's pivot points, we add half of this average range to today's close in order to calculate the resistance, and we subtract half of the average range from today's close in order to calculate the support. Another way to project one day's key levels based on the previous day is by using DeMark's projected ranges, which are discussed more in depth in Thomas DeMark's book called The New Science of Technical Analysis. In this slide, you can see a summary of DeMark's technique for projecting tomorrow's ranges based on today's prices. You can see that the projection for tomorrow's ranges is based on whether today's session has been bullish or bearish, and the projected ranges are a function of today's high, low, and close values. Throughout the history of day trading, a few patterns have become notorious. One summary of such patterns is outlined by Tubb's Intraday Patterns from the book Stock Market Correspondence Lessons that was republished in the 70s. There are 6 dominant patterns in a trading session from 10 a.m. to 3 p.m. Let's observe the rules. Number 1. If the market starts by rising and then returns to the opening price by 1 p.m., the day is expected to close weaker. Number 2. If the market is strong from 11 a.m. to 12 p.m., it will continue to be strong from 12 p.m. to 1 p.m. Number 3. If a reversal from 1 p.m. to 1:30 p.m. finds support at 1:30 p.m., it will close strong. Number 4. If the market has been bullish until 2 p.m., it will probably continue to be bullish until the end of the day and into the next day. Number 5. A rally that continues for 2 or 3 days will most likely end on a 11 a.m. reversal. Number 6. A late afternoon downward reaction after a strong day shows a pending reversal. Another useful way of looking at intraday prices is to look at the distribution of highs and lows in terms of time, meaning what are the times of the day that are more likely to be the high and the low of the day. There have been several studies across many different markets showing that the very beginning and the very end of the day are most likely to be the high or the low. These studies also show the following guidelines. Number 1. A gap opening upward can be the high or the low for the day. There's roughly a 50% chance of being either. Number 2. If an upward gap is the low for the day, then the high is more likely to be made in the afternoon, especially at the close. Number 3. If an upward gap is the high for the day, then the low is more likely to be made in the first part of the day, then a recovery in the afternoon does not make a new high. It's also interesting to observe that gaps play an important role in day trading. Another study performed with 275 stocks showed that most gaps range between 1 and 3%, and on average, price tends to pull back 40% of the gap. That gives rise to the guideline that if the market opens with a gap, you can wait for a 40% retracement to re-enter the market. Statistically speaking, that's the optimal solution. Beyond the distribution of highs and lows and gaps, large studies across multiple markets also show statistical patterns regarding different days of the week. These studies can be summarized in the following guidelines. Number 1. Tuesdays have a tendency to reverse the direction traded on Monday. Number 2. Wednesdays and Thursdays have no bias. Number 3. Fridays tend to be favorable to the direction traded on Monday with roughly 60% chance. Remember that these are just guidelines that may help day traders make a final decision, but they are simply guidelines. They are far from being rules. When we talk about intraday volatility, there are two main guidelines that help day traders predict what's going to happen throughout the day to some degree. They are, number 1, an opening bar with higher volatility generally means greater volatility for the rest of the day. Number 2, volatility follows a U-shape throughout the day, meaning that volatility is high in the morning, it decreases in the middle of the day, and tends to pick up again at the end of the day. Once again, these are just guidelines, so you will find instances where the complete opposite happens. We move on now to a few of the classic intraday breakout systems. Keep in mind that this is a beginner's guide, so I will only show brief guidelines and rules about some of the most famous breakout systems. This is by no means a comprehensive collection of such systems. As I said earlier, I will provide resources if you want to go deeper into the study of day trading techniques. Intraday breakout systems became extremely popular in the 1990s due to the advancement in computers and the availability of data feeds. These systems involve simple rules based on the breakout of high and low ranges established in n number of minutes or n number of bars. The system can also be built around a volatility breakout, and day traders often use a trend filter to qualify trades in order to further enhance the system. Out of these notions emerged one of the most popular intraday trading systems of all time called opening range breakout system, which has many variations. One popular version of the opening range breakout system is based on time, and it's called first hour breakout. The rules of the system are: number 1, wait 1 hour after the market opens. Traders tend to use 5, 15, or 30-minute bars. Establish the breakout levels as the high and low of the first hour. Number 2, buy if price moves above the 1 hour high. Number 3, sell if price moves below the 1 hour low. 4, reverse the trade if price crosses the opposite level. Number 5, exit the trade at the end of the day. These are the basic rules of the breakout system, but traders will often complicate the system a little more by employing different rules for stop loss and take profit targets. One of the problems with the opening range breakout system is that if the opening range is too narrow, the signals tend to be less effective. For this reason, instead of a breakout system based on time, some traders create a breakout system based on volatility. One generic example of the opening range breakout system based on volatility is to measure volatility using the ATR indicator, and then establishing a volatility range based on this value. For example, the trader will measure the ATR anywhere between 5 and 20 days, and add or subtract a percentage of that ATR, usually 50%, to the opening prices in order to form a breakout range. The rules are the same as the opening range breakout system based on time. A slight variation of this system consists in placing the ATR range around yesterday's close instead of today's open. In the case today's open price opens with a gap, this variation will provide a different breakout range. Many traders like to increment these intraday systems by adding a trend filter, which in most cases will be a common moving average. For example, the trader will only place a long trade based on the opening range breakout rules if price is above a 20-period moving average, or only place a short trade if price is below the 20-period moving average. If you decide to go after the study of day trading, you will see that there are too many different strategies, patterns, and variations. However, it's also important to know the advantages and disadvantages of day trading beyond the study of techniques. Let's begin first by exploring the advantages. The first thing that comes to mind when we talk about day trading is the possibility of generating profits in a very short term. This is the number one reason why traders get attracted to this mode of trading. Indeed, there are too many ways of exploring intraday patterns to the point where it's almost difficult for the trader to choose which strategy or pattern to focus on. The second advantage is that day trading allows for the possibility of frequent trade opportunities. The larger the number of strategies and patterns a trader knows, the larger the number of opportunities he will be able to see throughout the day. If you multiply that by the large number of markets available to the retail trader, you'll see that one retail trader will only be able to explore a small fraction of the available opportunities in today's markets. The third advantage of day trading is that it doesn't require a great deal of patience like other modes of trading like swing and position trading, where the trades last for days, weeks, and months. Day trading opportunities will last between minutes to hours, since the positions must be opened and closed in the same day. The fourth advantage is that day trading is flexible, meaning that you can choose certain times of the day to try exploring strategies and opportunities. In other words, if you want to day trade, you don't have to spend the whole day in front of the screen. By the way, you should never try to substitute your job or company for day trading. That's a terrible idea. These four advantages are really powerful attractors to any trader, and they are enough to motivate a lot of traders to get into the world of day trading. With that said, let's now explore the disadvantages of this mode of trading. The first disadvantage of day trading is its opportunity cost. Opportunity cost is the best alternative you give up in order to act in a certain way. If you day trade for a whole trading session, you are giving up all the other things you could do with that time instead. The problem here is that some people believe they can use day trading as a substitute for work. This is wrong. Day trading is a form of speculation, and speculation is a form of capital gain that is not deterministic, so it cannot be used as a main source of income. If you want to spend the whole day in front of the computer after trade opportunities, you must have a very stable financial situation that doesn't require a lot of your time. A lot of retired people get into day trading for this reason. They are financially stable and also free of work, so they can jump into day trading as long as they are responsible, of course. However, if you don't have a stable financial situation and you spend the day looking at charts, it means that you are unemployed. My advice is that you find a job or open a company, and on the side, you can trade for maybe a couple of hours a day. That's a lot more reasonable. Another disadvantage of day trading is that since opportunities happen quickly, the inexperienced trader can have difficulty managing his emotions in real time. Depending on the strategy of choice and the time frame of application, the trader will not have a lot of time to think about the trade, and this is extremely dangerous for inexperienced traders, especially if they are not aware of behavioral finance. When we have to make quick decisions, our brains use what are called heuristics to make decisions. Heuristics are mental shortcuts that allows us to make fast decisions. The problem with fast decisions is that they are not necessarily good decisions. Align this situation with the available leverage in today's markets, and you have a recipe for disaster. Another problem of day trading is that certain traders with a specific type of personality will get bored even with opportunities that last several minutes to a few hours. So they will try to take the idea of day trading to the limit by triggering too many trades that last a few seconds each. This is the known paradigm of retail scalping, which is a really bad road to go down to. If you want to learn more about that, please check out my Ultimate Beginner's Guide to Scalping in the video card, where I explore the problems of retail scalping in greater detail. Another problem of day trading is that traders cannot count on fundamental and macroeconomic factors like swing and position traders can. The reason for that is that fundamental and macroeconomic factors happen in a time horizon that is much larger than one day. So the only choice for day traders is to find some sort of pattern embedded in the short-term noise of the market. This is part of the reason why day trading gets a bad reputation sometimes. More conservative types of traders will claim that it's not really possible to explore patterns in market noise, and a trader needs to count on fundamental and macroeconomic analysis as well. This concludes the Ultimate Beginner's Guide to Day Trading. Keep in mind that this video only scratches the surface of the knowledge available on this topic. If you want to get deeper into the subject, you can start by checking the references I made throughout the course. From there, you will find other references to continue your research. I hope this video serves as a good primer to put you in the right direction if you are interested in day trading. If you like the material I produce in this channel and you wish to support it, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. If you want to learn how to trade, please check my paid courses in the links available in the video description. Thank you very much for watching, and I hope to see you in the next videos. Take care.